Uh, Thank you, everybody, for your patience. It is 1:02 Eastern Standard Time, so it looks like we're going to get started. So today we're here to talk about long-term care insurance and more specifically the alternatives associated with long-term care insurance. But before we get started, I would like to spend just a couple of minutes talking about the environment that the federal employee is working through right now, specifically the executive orders, and maybe touch on what's happening within the markets, which directly drives the thrift savings plans as well. So we're going to be moving a little bit more quickly through the underlying subject matter, but I do think it's important just to quickly talk about what we're dealing with as a federal community. And before we get started, one of the things that I always ask myself when I'm looking at a seminar is, okay, who is this person who's speaking to me, and why should I care what they have to say? So my name is Greg Klingler. I'm the CEO of GEBA. I've been a financial advisor for 20 years working with federal employees, and I also hold a chartered federal employee benefit consulting designation, among other designations that prove competence within the federal workforce's benefits and the information associated thereof. All right. So I know there's been a lot of information, some of which accurate, some of which misinformation, a lot of politics and a lot of emotions associated with executive orders. Here at GEBA, we're not here to argue the constitutionality, the ethics, the legality of the changes in the executive orders that have been pushed out in front of us. What we're here to do is try to give people the best information possible to make the right decisions, because the one thing that we do know is that people will be leaving the federal workforce either voluntarily or involuntarily. And we want to make sure that those people have the best information possible to make the right decisions for themselves and their family. That's the goal. So how did this whole thing start? It started with the deferred resignation. Effectively, people were given until, I want to say, February the 6th to make a decision. They were then allowed to keep their benefits through the end of September, benefits and pay. The underlying goal was to downsize the federal workforce. About 60,000 people or so took advantage of that, but that was just the tip of the iceberg. It's been reported through numerous channels that the federal government is looking to downsize somewhere in the neighborhood of 20 to 25%, different agencies by different amounts depending on the agencies and the determinations thereof. But at the end of the day, again, we're not arguing the legitimacy of any of these orders. What we know is the federal workforce will be reduced, and those people will either retire or resign voluntarily or involuntarily. Recently, and this has not happened for all agencies, but for many agencies, they've rolled out Deferred Resignation 2.0 or Fork in the Road 2.0. And the reason behind it is now federal employees may feel a little bit more legitimacy to this program because there were a lot of questions to be had prior to the rollout of the first program. And what we are seeing is more people are taking this program than 1.0, if you will. It does require a decision, and that decision, the date that the decision is required by is changing from agency to agency. But what is the same is the September 30th, 2025 deadline when you stop receiving pay and you stop receiving benefits. Please note that if you take advantage of the deferred resignation, you may see a reduction in your pension calculation, or you may see a loss of health benefits when you do retire. And one of the major questions that we ask ourselves is, are you subject to another program if you're looking to retire? Are you subject to VERA? Are you subject to DSR? Are you subject to VSIP? And we'll go over those very, very quickly. All those factor into the best decision for you and your family. VERA basically allows you to take your retirement early with no reductions and maintain health insurance when you otherwise would not be able to. DSR is very similar to VERA, with the one exception: to be eligible, they have to get rid of your billet. So the job doesn't exist anymore. That's what turns your loss of employment into DSR, discontinued service retirement. They're offering another carrot, which can be offered in conjunction with some of these other different options, whether it be VERA or DSR, and that's the Voluntary Separation Incentive Program. The government is authorized to pay up to $20,000 lump sum for people who leave the federal workforce, up to $25,000. The next kind of below the line is involuntary reductions in force, the elimination of agencies or job functions or positions. And then lastly, the courts have upheld the fact that probationary employees can now be laid off as long as the reason for being laid off is accurate and the decision is made by the underlying agencies. So what you need to pay attention to is, will you get your pension? Will it be reduced or unreduced? And will you have access to your health insurance post separation of service? As a general rule, you can retire at your minimum retirement age with 30 years of service, age 60 with 20 years of service, age 62 with 5 years of service. If you retire early, your pension would be reduced by 5% per year, and you could lose access to health insurance. VERA, provided you are 50 years of age with 20 years of service or 20 years of service without any requirements for age, will allow you to take your pension immediately with no reductions and maintain your health insurance. Now, non-VERA. This is where we have to pay very, very close attention. So in this particular case, we are retiring where you have between 10 and 30 years of service, and you've already reached minimum retirement age. So you can do what's called postponed retirement. Postponed retirement allows you to postpone your retirement during the time that you're waiting to take your pension. You will lose health insurance, but as soon as you take your pension, you will now be eligible to maintain a unreduced pension as well as return on your health insurance. Again, this is for people who are minimum retirement age and older. For those people who are not minimum retirement age and have not been offered a VERA, you have what's called deferred retirement. You can wait to take an unreduced pension, but you will not get your health insurance. You will not be able to maintain your FEGLI insurance. And during the time that you're waiting to take your pension, your survivors will not be protected. So as you're going through your options, deferred resignation, VERA, DSR, if you don't have access to those and you are RIFed or not provided with a carrot, if you will, to dangle in front of you to take your retirement early, you need to determine if you're part of the deferred pension or you're part of the postponed pension. I don't want to get into details here, but if you're part of the postponed pension and you're worried about your health insurance, there are ways around it allowing you to maintain your health insurance. So very, very quickly, that's kind of the scope of the landscape that federal employees who have been offered or who may be offered retirement or resignation options have at their disposal. I do apologize for taking up about 9 minutes of the time, but I do think it's important, considering what's going on, for you to have a strong understanding of different options available to you, your peers, and frankly, your friends within the federal workforce. All right, backing up to the presentation at hand. Again, my name is Greg Klingler. I'm the CEO of GEBA. We've been around since 1957. We are a not-for-profit organization serving a little over 16,000 members. What are we going to cover today? We're going to cover traditional long-term care, talk about what it covers, why you need it, why it makes sense for it to be part of a financial plan. We're going to talk about the alternatives that may allow and provide different options for you to care for yourself or your family members. And we should have a couple of minutes for questions. All right, so I've been doing this presentation for well over a decade, and I include this slide in every one of those presentations because it's not necessarily about the academia of long-term care. It's about what's best for you. Depending on your pension, whether the old pension or the new pension, whether it's foreign service or non-foreign service, um, depending on the size of your TSP, outside assets you have at your disposal, the concept and determination of long-term care can vary very widely for people who don't need long-term care insurance because they can self-insure it in other ways, to people who have very little savings and frankly do need to rely on an insurance carrier to protect them against this situation that has a high probability, a high potential, a high cost, and a high duration. So what is long-term care? Long-term care is, very simply put, the care that you need when you can no longer care for yourself. There are technical definitions that insurance companies offer, the inability to do 2 out of 6 activities of daily living. But the reality of it is, it's the care that you need when you can no longer care for yourself. So how does this care get provided to you? It can be sent to your home, your adult daycare, assisted living facilities, nursing home, and then at the end there's hospice. One of the things that all of these things have in common is, with the exception in most cases of hospice, there's a cost to it, a financial cost to it. Consequently, part of people's plans in some cases is my family's going to care for me, and in different cultures that is stronger than in other cultures. I am part of a blended family. My wife is Filipino. I'm German. I can tell you that my wife, the belief that the parents should be cared for is definitely stronger in her family than it is mine. But the reality of it is there's always a cost. If the family's providing care, well, then the cost is your family member's time, comfort, maybe their money as they have to take time off work. Studies have shown that no matter how many children you have, care that is provided by a family member is generally provided by one person. That person is generally female, whether it be a daughter or a daughter-in-law. And during the care, that one person, statistically speaking, has a 57% chance of that during that care being diagnosed with a chronic depression. There's always a cost. The question is it going to be dollars and cents, or is it going to be something else? So if you were to have long-term care insurance, when does it start getting kicked in? It's when you are unable to do 2 out of 6 activities of daily living. Activities of daily living include bathing, continence, dressing, eating, toileting, and transferring from a bed to a chair and back again, or a severe cognitive impairment. Once you meet this eligibility requirement, you have to wait the appropriate number of days, the elimination or the waiting period, and then you start receiving benefits for the length that the benefits have been promised. Now, the concept of long-term care is very important. And I would argue that more people with good otherwise financial plans are going to have their financial plans fail because of a long-term care need than any other risk associated with retirement. And the reason why is because there's a high probability of it happening. Between 50 and 70% of people between the age at 65 will need long-term care at some point in their lives. There's a high duration. The newest studies have shown that if a male goes to a facility, they're going to spend 2.2 years in the facility, and a female is going to spend 3.7 years in the facility. And the expense is high. In the Washington, D.C. area, the median cost of a full-blown nursing home room is $168,000 per year. So as we look at a retirement plan or a financial plan, one of the things we have to consider is, okay, let's quantify the risk associated with common things that are associated with retirement, and let's figure out how we're going to handle those risks. How do we mitigate it? Do we do it with our assets? Do we do it with our investments? Do we do it with our pension? Or do we do it with something else? Now, this information is a bit stale, but this is the newest information I can have. So when we look at trying to quantify risk, we look at best case scenario, we look at average scenario, and then we look at worst case scenario. And I mean, let me preface this with Medicaid doesn't track this and report it. Nursing homes typically do not report it. The industry that loves tracking and reporting things is the insurance industry. So these are people who own long-term care insurance policies, who are using long-term care insurance policies, and these are the largest amounts on claim. For a man, it was about $1.6 million and growing. For a female, about $2.6 million and growing. Now, why did I tell you that? Because as we look to quantify the risk and hold it against your financial plan, we need to understand, where do you fall on the sliding risk spectrum? Are you average? Does your health and your age dictate, and your family history dictate you being below average? Or does it dictate being above average? I can't really answer that question better than you can, but as we talk about financial planning, that's one of the discussions that we have. So now we have best case, you don't need long-term care. Worst case, the slide in front of you. And average, 3.7 years for a woman, 2.2 years for a man. When you retire, where you retire absolutely matters. Not only from an income tax perspective, most people have heard that Delaware and Florida are very friendly from a tax perspective during retirement, but also from the cost of care. The national average for a cost of a private nursing home is $116,000, but that's going to vary very widely from a cheap state to an expensive state, with Texas being about $80,000 per year for a private nursing home, and Connecticut being well over double that at $198,000. Now, I've worked with a lot of federal employees over the years and their families, and one of the things that they always are hoping that I say is, you can self-insure. You do not need long-term care insurance. And there will be people on this call where the answer is, absolutely, that's correct. Your TSP is large enough, your pension is large enough, you have enough assets outside of those items to effectively self-insure against this risk. But let's talk about what that costs in order to do so. If we assume somebody who's age 55, they need the care at age 85, the cost of care is $168,000. That's in the Washington, D.C. area. The number of years of care they need is 4, which is about average for that of a woman. We assume the cost of care increases because of inflation at 3%. A person would need to set aside, outside of their retirement budgetary needs, about $368,000 per person today. There are going to be people who absolutely can do that. The question is, can you? And if you can't, what's the next decision that you need to make? Because we can pay for care in a lot of ways. There is insurance. But if we go self-insurance, you have your pension, your TSP, your Social Security, your savings, real estate. Many people use the sale of their primary residence as a buy-in for a retirement community. That's just an example. Now, we do a lot of work with an educational company in Maryland, and this is just something that they've kicked out over the years. One of the things that I have found is, talking about long-term care is a very scary proposition. The idea that you can no longer care for yourself puts a lot of fear in people, and human nature tells us we generally lean away from fear. I've met with couples, and we've talked about life insurance and their death, and it's almost a joking experience. When we start talking about long-term care, it gets a lot more serious. But at the end of the day, a failure to plan is a plan to fail, and that risk will not go away if we ignore it. In fact, it'll probably be worse. The next thing that people ask is, if they need long-term care insurance, which is not a given, when should they enroll in it? Now, most people enroll in their mid to early 50s. And the reason behind that, in many cases, is the fact that their children have graduated college, They're now focused on their retirement. Long-term care is part of their retirement. But it also tends to get much, much more expensive after your mid to early 50s. And your health is only as good until it's not. The longer you wait, the higher the percent of being declined is. And there will be a time where if you wait too long, you will price yourself out of being able to afford long-term care insurance as an option. All right, so let's quickly talk about traditional long-term care insurance plans. The federal long-term care plan, as well as traditional inside the industry, are going to operate the same effectively based on these different items. So first is benefit amount. When I'm speaking in front of an audience, I do have to ask the question, okay, what do you think is better, daily or monthly? Most people I hear murmuring daily, monthly. The truth is, if you're looking for flexibility, and most people are, especially for people who want home care, monthly tends to be apples to apples a better choice. And let me explain why. Home care is particularly variable in nature when it comes to cost. Let's say on Monday you have 3 doctor's appointments, you need to be bathed, you need to be fed, you need your medication. Monday is a $400 day. Tuesday rolls around and most things have been handled on Monday. Tuesday is a $200 day. Wednesday, your daughter-in-law is off work. She comes and takes care of everything. Wednesday is a $0 day. If you have a daily benefit, unless it's a very, very big one, you're probably going to come out of pocket on Monday. Whereas if you have a monthly benefit, you can average out the high days and the low days, and it just provides a lot more flexibility, especially for people who are looking to have care take place in their home. And let's be honest, most people want the care to take place in their home. The next item, home care benefit. So if you or your parents purchased a long-term care policy pre about 2006, home care was not nearly as large of a benefit as it is today. So if you are looking at an older policy, you're definitely going to want to zero in on home care. For many people in this call, that's going to be looking at your parents' policy to see how much home care is offered. All right, the benefit period. That is the length of time that the benefit amount will be paid. Now, the federal long-term care people used to give a pretty nice metaphor, and they call it the gas tank. The amount of long-term care gas that you have at your disposal is the factor of your benefit period times your benefit amount. That amount is the total amount of long-term care you have at your disposal. You can only spend it as fast as the benefit amount, no faster, but you can always spend it slower and it will last longer. We tend to recommend, if a traditional long-term care plan is the ideal situation for you, we tend to recommend what's called a short fat plan, which means a shorter benefit period, but a larger benefit amount. It just gives you more flexibility in the case of a catastrophic issue. And the cost is relatively non-substantial. Waiting period. The amount of time that it takes to become eligible for long-term care benefits when you are no longer able to do your 2 out of 6 activities of daily living. Most carriers are 90 from a financial planning standpoint. That's a pretty easy number to plan around. And we find that because most carriers offer that, that's where the competition is the greatest as far as the lowest price. Inflation protection. This is another big one because we really don't care about the cost of long-term care insurance now, other than we use it to extrapolate what the cost of long-term care is going to be when you in fact need it. With that being said, we highly recommend having some sort of inflation protection rider. If you look at the history of the cost of long-term care, we're seeing 3 or 4% make the most sense, and 5% being quite expensive. So let's quickly talk about costs. And let's just focus on 4 years. As you can see here, if we assume $6,000 monthly benefit, 3% compound for inflation, 90-day elimination period, best health rating, the cost for a male for 4 years of coverage who's age 55 is going to be $3,200. The cost for a female is going to be $5,671. Why is it so much different? Because the average man spends 2.2 years in the facility, while the average female spends 3.7 years, and insurance companies hate additional risk. Now, if a couple purchases coverage, that's when we see a lot of discounts that can be applied. So assuming a $200 daily benefit, 3% compounded, 90-day elimination period, and the best health rate, the cost for individual policies is going to be $5,671, and that's coverage for a heterosexual couple, the male and the female having separate policies. For those of you who are part of a same-sex couple, this quote is going to be cheaper for 2 men and more expensive for 2 women. And if you do need specific quotes to your specific needs, please reach out to us and we'll provide that information to you. But as you can see, the difference between a single female and a couple buying it together, there is almost no difference. And that's because you get a discount for being married and you get a discount for buying it together. As you can see, we also have something called the shared care plan. And that is a plan where if one person exhausts their coverage, they can then dig into the other person's coverage. Anything left over is still going to be available for the other person. In the financial planning world, flexibility can be very, very valuable, but flexibility tends to come with a cost. The question is, in your specific situation, is that cost worth it? All right, this is an actual example from one of our employees over the years of a shared care policy. We had a male who bought in at 57 years of age, a female who was 48. They were married. Their monthly benefit was $4,500 for each person. Their premium was $3,161. It was relatively inexpensive because they were still young, particularly that female. 4 years of coverage for each person, 5% compounded for inflation. The benefit pool, or the gas tank, if you will, was $432,000. This particular employee left our employment in 2022, so this is why I don't have any more up-to-date numbers, but this gives you the idea. That 5% compound for inflation caused the monthly benefit to go up dramatically to $9,354. Inflation, the cost of long-term care insurance has pretty much gone up for everybody, and this product was no exception. The premium did increase to $3,934, providing a benefit pool with that benefit gas tank of almost $900,000. Now, with that being said, if I was talking to a federal employee who had a substantial pension, so a career-based federal employee, one of the conversations that I'd have with that person is, this is a very, very big policy. In fact, a policy is probably too big for most federal employees because they are able to self-insure a portion of the risk because of their pension and their TSP. So we would be having a conversation with them about maybe we can save you some money by choosing a more right-sized product for them. The same long-term care policy, just something a little bit ratcheted down to save them some money. Most federal employees, the federal employees who need long-term care policies, typically do not need large policies because they do have that self-insurance in the form of the pension, Social Security, the Social Security supplement, and the TSP. All right, so moving on to alternatives. There are a number of reasons why people who know they need long-term care insurance because they can't self-insure the entirety of the risk don't buy long-term care insurance. And there's 2 primary reasons. One is use it or lose it. Well, what happens if I don't need long-term care? Because there are people on this call who won't. I don't want to spend this large amount of money on premiums for it to never be used. And the other reason why people choose not to buy traditional long-term care is because they've seen their peers, their policies become much more expensive. In 2016, the federal long-term care plan increased rates an average of 83%. And in, what was it, 2024, they did it approximately the same amount again over a 3-year period. Private plans have also gone up in cost. And the fear is, as you move into retirement in a fixed income situation, I don't like the fact that things can get more expensive. Many of the alternatives that we're going to talk about today alleviate those two concerns. For those of you who are interested in the federal long-term care plan, and single women were definitely, that was the first place that you should look for long-term care insurance because they had gender neutral pricing. Unfortunately, the federal long-term care plan has been suspended again until at the very earliest December of 2026. This is the second time. And when it comes back, I don't know what it's going to look like. So with that being said, for those people who are waiting for the federal long-term care to come full circle and to open back up, I would generally recommend not making that part of your plan just because there are too many question marks associated with the federal long-term care plan. For those of you who are in the federal long-term care plan, I don't suspect you're going to lose coverage. And for those of you who've had the federal long-term care plan for at least 3 years, that's probably the absolute best plan you should be in. And odds are you should remain in that plan, although we're happy to take a look at it just to make sure. All right, we mentioned the benefits of these alternatives. Use it or lose it, because most of the long-term care alternatives that we're going to talk about today are built off of a life insurance chassis, which means if you don't need it for long-term care, it's going to pay out in the form of life insurance. And because it's life insurance is what we call non-cancelable insurance. Whereas long-term care insurance, the traditional kind, is what we call renewable. Renewable would be like your home insurance or your auto insurance, where they can't kick you off, but they can definitely increase rates to classes of people. Long-term care can increase rates. Life insurance cannot. So if I was going to tell you which slide contains the most comprehensive information about alternatives to long-term care, it would be this slide. At the top of the funnel being the biggest long-term care benefit for the smallest premium buck. Long-term care, traditional long-term care insurance will always provide the best long-term care insurance for premium dollar. Moving down, we have what's called linked life insurance with long-term care. With this, I want you to think little life insurance policy, big long-term care benefit. Moving a step down, we have linked annuity long-term care. With this, I want you to think it's an annuity. We all know what an annuity is. Your pension is an annuity. But if you fulfill the definition of being eligible for a long-term care benefit, it's going to multiply by 3 or 4 times, depending on your age. Moving down, one more is the life with chronic illness rider. With this, I want you to think big life insurance policy that I can spend early for long-term care. And below that, I typically draw a line. For people who miss the boat for any type of comprehensive coverage, whether it be because of age, health, or cost, these are options that are available to you or your family. All right, so first example. This is life insurance with a long-term care rider. So with this, again, I want you to think little life insurance, big long-term care benefit. We have a male who is age 55, married, best health, 5% compound inflation, 5-year benefit period. These typically require a large upfront commitment. It can be a single pay. In this case, we are showing you an illustration that's a single pay, but you can pay up to 10 years in most policies. So $50,000 up front. If you ever want to walk away, you can walk away with $35,000. At age 85, your death benefit is going to be $57,000. So not a huge increase. But your long-term care pool at age 85 is going to be $630,000. We are able to move past to use it or lose it because there is a death benefit, albeit relatively small. And it will not become more expensive. You never have to come to the table with more than that $50,000 of initial payment. Next, we have life on 2 people's lives, in this case, a heterosexual couple, both age 55, married, best health, 3% compound with a 66-month benefit period. Now we're coming to the table with a full $100,000. Annually, an additional $1,887, never to increase because this is based on a life insurance chassis. If you ever wanted to walk away, each person could walk away with $35,000. At age 85, the death benefit is $121,000. And the long-term care benefit pool is $572,000. Now, if you're paying attention, you may have the question, why is the benefit pool lower on this slide and the premium is double? Well, the answer is because now we're talking about two people, and the probability of two people going into a care facility, one of those people going to a care facility, creates a situation where it's a higher risk. All right, next, this is kind of the cousin of the previous two slides. Now we're talking about universal life insurance with a long-term care insurance rider. Universal life insurance allows for flexible premiums so you can pay differently every year. Traditionally, you don't want to, but it does give you a little bit more flexibility. It also allows traditionally people who are a little bit older to take advantage. In this case, female, age 65, married, best health. Upfront premium of $100,000. After 5 years, you can walk away with $100,000, no questions asked. At age 85, $123,000 of death benefit and a long-term care benefit pool of $417,000. Why is this less? Because we're talking about a female now who's 10 years older when they sign up, but also because females tend to use more long-term care benefits than men. All right. So now we have an annuity with a chronic illness rider. Another big upfront commitment, $100,000, plus an annual premium of $1,551, never to increase. It's going to provide a monthly benefit of $6,250 at age 85 for a total benefit of $300,000. If you die without using it, your heirs will receive an annuity value of about $104,000. Again, this is male, age 65, average health. All right, so this is the most popular in the industry as it stands right now. So this is the life insurance with the chronic illness rider, or as I described before, big life insurance policy that you can spend early. The devil is in the details here. There's generally two types of policies. One is what's called dollar for dollar. For every dollar that I use for long-term care, my death benefit is reduced by $1. Very straightforward. The other one is what's called prorated. And so for every dollar I use for long-term care, it's going to create a prorated amount that's reduced from your death benefit. And it's prorated because an insurance company is going to say, well, you're using it early. We could have made interest on that money while we were waiting. Because you used it early and we were expecting you to die at age 85, but you used it at age 80, we're going to take away $1.15 from your death benefit for every dollar of long-term care that you use. The calculation is actually, in many cases, placed in the policy directly, but it's not quite as good. So again, the devil's in the details. Understanding which type of policy you're getting is very important. This is also the first policy where women are cheaper than men because these are primarily life insurance policies, and women tend to live longer than men on the average. So in this particular case, we bought a $250,000 death benefit life insurance policy. You can spend up to 4% of that death benefit early, or $10,000 per month, and the cost for coverage for a man was $3,722 per year. For a female, $3,388. All right, so now we've gone below the line. Now, traditionally, this is for people who've been forced out of traditional long-term care either because of cost, age, or health. You may have some parents that fall into this category depending on the situations. So short-term care allows for up to 1 year of coverage. In this case, for a 65-year-old, annual premium is going to be $1,425. Coverage is going to be $200 per day. But it's only for 1 year now. Going down that funnel, Now we have the home health care only policy. Very simple to get insured as long as you're between the ages of 41 and 85. In 48 states, there's only one question. Are you physically unable to perform your activities of daily living? In 2 states, New Hampshire and Alabama, they ask one additional question. Are you currently also receiving home health care services? If you can answer correctly to those 2 items, it can provide some care inside your home. And that care is going to be up to $300 per day for half of the year for skilled care, up to $80 per day for non-skilled care. And you are going to get discounts for things like prescription drugs, taking an annual physical, or an annual vision exam. So how do you determine your plan? Well, again, where you retire matters. Is it going to be inside the United States? If so, which state? From a tax standpoint and a cost of care standpoint, those things need to be factored into your financial plan. Are you going to stay inside the US, or are you going to go abroad internationally? That's going to have a direct impact on what type of long-term care insurance plan makes sense to you. Do you qualify based on your health for plans? What type of policy is your preference? And frankly, what does your financial plan look like? Do you need long-term care insurance? Now, no conversation about long-term care would be complete without understanding what a reverse mortgage does. I'm sure most people who own a home know that your houses have appreciated very dramatically since the beginning of COVID. There's a lot of equity in most houses. Can you use your equity to help fund your retirement? Absolutely. Can you use your equity to help fund and protect you from the risk of long-term care? Absolutely. Is reverse mortgage the best way to do so? In almost all cases, the answer is no. It's an option, but I would really make that more like a plan C or a plan D. And let me tell you why. So we have a couple who's age 68. They have a home that's worth $500,000, no mortgage. The great thing about reverse mortgages is no matter how much you own the house, the bank can't kick you out, even if you're underwater. But with that being said, banks hate risk. So banks do things to protect themselves, like creating reserves and putting costs on reverse mortgages. So in this particular case, your funds available in day one would only be about $159,000, with the rest of your equity going towards reserve, protecting the bank, and the cost of the reverse mortgage. So again, is this an option? Is this a plan? Yes. Is it a primary plan? In most cases, I would say no. Next, continuing care retirement communities. Now, we have no dog in this fight, but we have found, and we have about 2,000 members who are over the age of 70, we have found that unless there's a very strong familial unit, people who are in continuing care retirement communities tend to have more golden years. And the reason why is because you can go in when you're healthy into independent living. As you need care, it shows up at your door. If you need to go to a nursing home, there's one available on this in the facility. You never lose those personal connections with your friends and family who live on campus because they're there to support you. And that can be very, very powerful, especially as people age gracefully into their golden years. Now, nothing comes without a cost. Most couples use the sale of their primary residence to fund the buy-in into these type of communities. If you have long-term care insurance and you fulfill a definition of needing long-term care insurance can help cover the cost. The general buy-in is about $485,000, give or take today. If you want a penthouse, obviously the cost is going to be much higher. All right, so recap. As a federal employee, you could probably self-fund some of this risk. The question is how much, and is it all? If it is not all, how are you going to cover the rest of the risk? How are you going to outsource that risk? In many cases, long-term care insurance makes sense, but what kind? What kind is best for you? For those people who need to pull that emergency ripcord, there are things like Medicare. Medicare will cover up to 20 days of care, provided that you were admitted into a facility for 3 straight nights. After that, there is a copay for days 21 through days 100. If you run out of money, and I mean really run out of money to almost zero, there is Medicaid that will support you to make sure you're not thrown on the streets. If you give away your money trying to get to that threshold, Medicaid's going to claw back 50 months and take it back from people you gave money to. The VA also will make sure you're not thrown out on the streets if you're eligible, and there is no clawback period for the VA. If you're looking for more details on that, please reach out to us. At the end of the day, for most federal employees, it's going to be a combination of a number of these items that makes sense for most federal employees, with self-funding being a key attribute to that. And then sometimes a right-sized plan of some type of insurance. As a civilian federal employee, you have access to a lot of benefits. Understanding the benefits clearly, and then supplementing and augmenting the benefits in an efficient way is the ideal situation as you look to plan for retirement or as you look to fund a loved one's long-term care stay. For those needs, GEBA can help. So again, we've moved through a very deep conversation when it comes to long-term care. And in addition to that, we talked about the federal landscape when it comes to all these executive orders and decisions that need to be made as people are looking to voluntarily or involuntarily leave the federal workforce. If you don't have a trusted financial advisor who understands federal benefits extremely well and understands what's happening with the federal workforce, and you're looking for somebody, please reach out to us. We were put on this earth back in 1957 to help federal employees, and these are the times that we can provide the most help. All right, so I have about 10 minutes that I'm going to open the floor to questions. If you do have a question, if you can reach out in the chat box, I'll answer any questions I have time for. If I don't have time, I'll do my best to answer questions in an email, as long as they're not too personal in nature. All right. If we're involuntary, so first question is, if we're involuntarily separated, can we pay for long-term care still ourselves? And the answer is yes, on all accounts. So if you have the federal long-term care plan, yes, you can absolutely pay for yourself to maintain coverage. If you have a private plan, the answer is absolutely yes as well. One of the nice things that the federal long-term care used to allow for is for you to enroll parents in coverage, and that also is a yes. You can continue to pay for that. Next question is, does long-term care coverage dementia or Alzheimer's? And the answer is yes. So in order to be eligible for traditional long-term care insurance, or frankly, any of the alternatives, you need to be able to not be able to do 2 out of 6 activities of daily living. So activities of daily living, bathing, dressing, eating, being able to transition from a chair to a bed and back again, continence, those are all activities of daily living. In addition, if you have a severe and chronic mental situation like dementia or Alzheimer's, that will also make you eligible for long-term care benefits. And whether you need long-term care is ultimately determined by a doctor, just for your reference. Long-term care partners. So if you're referring, so the question was, what about long-term care partners? And this is related to can you continue to pay for long-term care yourself? So if we're referring to long-term care partners, which is the federal long-term care plan offered through John Hancock, the answer is yes. If we're referring to partnership which is what I believe 17 states now allow you to protect your money from Medicaid and have long-term care insurance? The answer is also yes. All right. Suppose you can function but don't remember to eat or wash. In most cases, this is a question that is a secondary question to does long-term care cover dementia or Alzheimer's situations? Suppose you can function but don't remember to eat or wash. Now, it's ultimately up to a doctor, but if you can't remember to eat or wash, most doctors that I have seen would absolutely consider that the inability to do that and would allow for coverage to remain. Just for your reference, though, if you suffer from Alzheimer's or dementia to such an extent where you wouldn't remember to do those things, that is the only question for eligibility. If you have dementia and Alzheimer's and it's that significant, you are now eligible for long-term care. You don't have to worry about the 2 out of 6 activities of daily living. So I apologize if I wasn't more clear. All right, so it appears that we've answered all the questions. If you do run into a question that you didn't either was too personal, feel free to reach out to us at the email address that you see in front of you. If you think of a question later, feel free to jot down that email address and reach out to us at a later date or give us a call. We're happy to help. If you have questions on what you should do if you receive a VERA or a DSR or a voluntary separation incentive program, or you're looking to be RIFed and you want to know how it's going to affect your retirement, your pension, or if you have questions about the market and your TSP and how your portfolio should be allocated to protect you from the market, please reach out to us. Yesterday was a bit of a bloodbath when it came to the market. Today was quite good. And it seems to ebb and flow on information that's projected to the market from the administration. We're happy to help anyone we can. Please use us. There will be a survey at the end of this presentation. Please fill it out. Our presentations are only as good as the people who came before you. So we take what you say very personally, and we look to add those to our seminars going forward. So thank you very much. I appreciate your time and have a great day.